Hello, this is Fred, your friendly neighborhood realtor here in Orlando, Florida. Today we're going to talk about a subject that you hope you never hear when you're putting in for a mortgage application and trying to buy that home. That's going to be your mortgage loan got denied, and what are you going to do next? For starters, just keep in mind 8% of the mortgage applications out there do get denied. Let's look at the process of where that denial usually occurs, and then we're going to look at 7 reasons why it may get denied. Now, mortgage underwriting is where usually if it's going to get denied, that's where it's going to be. And that's going to be the process where they're verifying and analyzing the financial information that you provided to the lender. That's going to be such things as your bank statements, your W-2s and other tax documents, your pay stubs, your IDs, which in most cases will be a driver's license. It could also be a military ID or a social security number card. And one thing that you may need, but not everybody will, and that's going to be letters of explanation or gift letters. That's only going to be if it's necessary and if that applies to you. Now, to look at the 7 reasons why mortgages get denied, let's look at those right now. For number 1, your credit score is too low. Now, if you're trying to apply for a conventional mortgage, you may need to step back and look at an FHA. FHA is not as strict on the credit. If you have a credit score in some lenders, a minimum of 500, then you can get an FHA loan. Now, that 500 credit score will get you a loan with the FHA, but you must do 10% down. And you're going to need you're going to have a mortgage insurance premium as well. Now, if you have 580 or above, then in most cases you can do as little as 3.5% down. Now, a lot's going to depend on your lender, and your lenders may require different credit numbers. And I would suggest if you have a credit score below 500, you really need to work on your credit before you apply for a loan. Now, number 2, your debt to income ratio is too high. And what this means is you have too much debt. Now, if you increase your income, okay, that's going to be a different thing and you're in good shape. But where people sometimes run into problems with this is this. They contact a realtor. A realtor has a mortgage person that they contact and they talk with. They look at their credit score, they look at their credit, see what's going on there. They look at their income and they say, okay, this is how much you qualify for. And then what happens is, for whatever reason, between the time that you started the process by just getting a pre-qual, which isn't a guarantee that you're going to get that loan, but a pre-qualification, is that you went out and you made some large purchase on your credit card, or you went and bought something and you added to your credit, which means your debt increased. Now, truthfully, if you want a home, I'd try to hold off on any big purchases. And if you can do anything, the wisest thing and best thing that you can do is, prior to, pay down as much credit as you can, and then make those payments and not increase your debt. So you're going to have to lay off the credit cards for a little bit. Now, another thing, number 3, is going to be your loan to value ratio. Now, if you're going for a conventional rate mortgage, they really want 20% down. Now, if you do the 20%, you're good. If you do less than 20%, then one, they're going to add on a mortgage insurance premium. And that, of course, is going to add to your payment. But number two, they get a little bit more concerned. So say you only have 10% down. Then what are you going to do? Well, hey, look, the conventional rate mortgage may not be the one for you. What you may want to look at then is you may want to look at an FHA. Or you may want to look at a VA. If you're a veteran, the VA loans are out there available for you. Now, a VA loan you can do as little as 0% down. And you don't have mortgage insurance there. Now, even FHA, if you do less than 20%, you're going to have mortgage insurance. So the only way around it is either to do 20% down, or if you're a veteran, you can do VA loan. Number 4, employment recently changed. Lenders are going to want to look at 2 years previous income for verification of employment. If you recently changed a job, they're going to be a little concerned, because why did you change that job? Even if it's for more money, then I would try to give a little bit of time before you go trying to put in for a loan, and make sure you can justify that well. And at the same time, another thing that's going to make a difference with that change is, did you change from like job to like job? Meaning, just to simplify, if you were a manager of a restaurant, did you go from being a manager to a restaurant to all of a sudden a computer guy? And that kind of like sometimes throws them off a little bit. Now, if you changed from, say you were a manager at Darden Restaurants, which they run actually Olive Garden for one, plus some other restaurants. But say you went from Olive Garden and then you jumped over to, we'll say Eddie V's. Eddie V's is a high-end restaurant that's here in Orlando. Then you went from, you kind of went from like job to like job. So that may not be an issue. But if you kind of change jobs and you kind of change careers, they may kind of look at that a little bit funny. Now, number 5, unusual bank account activity, large deposits. If it's especially from an unknown source, it may raise red flags. Now, this goes back to when we were talking about some of the documents they want to look at is explanations, letters, gift letters. Aunt Sally gave you some money to do for a down payment. So you come up with a letter from Aunt Sally saying, okay, this is where they got the money, and I wanted them to have this money so they could do this down payment. And I'm not even looking for them to repay me. So that's kind of what you're looking at. So if you do get an Aunt Sally that gives you money for a down payment, then you may want to make sure you had that gift letter so in the very beginning you talk to your mortgage people. You let them know what's going on. Number 6, there's a problem with the property. During the inspection process or whatever, they found, say there's something wrong with their foundation. You have something major that's going to be kind of a big thing to take care of. Underwriters may not like that. Now, it may be something that you can go back to the negotiation table and work it out that way. Or you may want to say, it's time to find a different property. You're going to have to look at the situation and why or what the issue with the property was to determine what's going to be right for you. But that may be one that you may need to back away from that deal. And it may be the best interest of you. And then let the seller deal with their issues there. Number 7, you have a history of missed mortgage payments. Do you have a previous short sale, a foreclosure, bankruptcy? Now, if you've had a short sale in the past, you may want to make sure you have at least 2 years before you go putting in for that loan. If it's been a foreclosure, say a Chapter 7 Chapter 7 bankruptcy, and you had a foreclosure, might be able to get away with 4 years. But if you've had a bankruptcy with a foreclosure, you're probably looking more closer to 7 to 10 years. What I would encourage you is, if it's been less than those periods, is you talk to the mortgage person up front. You let them know what's going on. And that's in any case, anything. You be as honest with that mortgage person as you can, because they're actually there to help you. Just like as a real estate agent, I'm here to help people. So be upfront with them. Now, if you're looking to buy a home here in the Orlando area, we'll be glad to help you out. First of all, we'll get you in contact with some very good mortgage people that can help you find that loan program that's going to be right for you. So hopefully we don't run into any of the issues we've talked about today. Now, after the mortgage personnel tell you what you're qualified for, and then you come to us, and we take that information with what you're looking for and where you want to be, and we try to get you that home that you're going to be happy with. If you're looking to sell in the Orlando area, one of the key things you're going to want is a comparable market analysis. If you're in the Orlando area, we will do a market analysis for you for free. And what that's going to do is it's going to tell you approximately how much money you can get for your home on the market right now. And also approximately how long it's going to take to sell. Now, if you do need to contact us so that we can assist you with your real estate needs, our contact information is in the description below. And while you're down there, make sure you hit like for the video, subscribe for all our videos, and then a bell notification so that as we produce new videos, you get notified. Like I said, we're here to help personnel with their real estate needs. And it is a market out there right now that people are still buying and people are still selling. In some cases, in a lot of cases, it's just life events dictate that that's what they need to do. Either way, we're here to help. So if you have real estate needs and have questions, we'll be glad to help you out. Thank you, and have a good day.